So hi, everybody. Welcome. Thanks for joining our 2026 nonprofit update. I'm here to talk about the most exciting subject of all. That's the new accounting and auditing standards that we've seen the past couple of years. It's worth noting here that there's not a lot that's changed, which is good. So we're going to focus more on how to apply what has changed in the past few years, some common issues that we're seeing as accountants and auditors out in the real world, errors and mistakes that we're noticing and how to sort of avoid them. Really, technical rules haven't just changed. It's just the risk profile of everything has changed. And, we have examples of clients that have gotten financial, donations and contributions in the past that were accounted for one way and they're not aware of the new changes. And now they account for it a different way. And it's resulting in a lot of audit errors and management letter comments and things like that that we don't really want to have to report. So the first is really the most important area in terms of our agenda is the revenue and contribution rules, which continue to be a challenge to so many different organizations. So we're going to talk to everyone about applying a three-step framework on how to best respond to these changes, distinguishing conditions from restrictions. You're going to hear some cynicism in my voice a lot. I just can't help it. But the accounting rules love to take words that sound exactly the same and give them different meanings. Conditions and restrictions, for instance, and then avoiding common recognition and disclosure issues and making sure we're in compliance there. Some other accounting updates, again, nothing brand new, but relatively new. CECL, leases and software. We'll talk about some changes there and how to best respond to them now that it's not the first year of transition anymore. Some pending updates for city-funded organizations. There's a new SAFR, or SAFER, I guess we're calling it. We'll talk you through that and how to best prepare for those changes that are lining up and should be affecting you probably in the next year or two. Some updated uniform guidance rules for federally funded organizations. And then we bring it home with certain audit focus areas and action priorities to help you make this real and how to really respond to what it is we're telling you today. So an overall landscape here. We're noticing certain macro trends shifting from unrestricted general operating support, which is obviously very easy to account for, to more highly restricted, conditional, milestone-based programmatic grants. We're also seeing funders and government agencies demanding more distinct outcome measurements and compliance, always placing more compliance rules on you, an organization that is trying to comply the best it can with limited resources, limited dollars, limited staffing. We're all in this boat with you. We realize it's difficult out there. That's why we try to educate you and train you along the way so that you are best prepared to respond to these things and make sure that you're doing all you can to be in compliance and not face too much regulatory scrutiny. Audit friction points. We're definitely seeing an inconsistent application of conditional grant accounting. This is by far, and I see a lot of my clients on here. You've probably heard this from me and hopefully you haven't had an issue with it. But we're definitely seeing that there's difficulties in accounting for contributions, whether they're conditional or not, whether they're restricted or not, what year they belong in, what period they belong in, what gets disclosed, how to interpret things. It's not easy. We'll start all that with saying it's not easy and the rules are not easy to interpret. But again, that's why we're here talking to you. We're seeing CECL, the current expected credit loss model, which is really a new way to account for bad debts. We're not seeing that well known and understood out there. I think people hear it from us and just kind of gloss over and realize that it's not a monumental shift, but it's definitely something that should be taken into account and understood and really addressed. It's really a general lack of awareness of accounting standards and compliance requirements. It's why we do this every year. This is not the glitziest topic that you're going to talk about, despite what I said when we started. But it is important. And these are opportunities for you to really listen and understand what's happened out there, what you need to be aware of from an accounting and finance standpoint, so that you are in compliance, so that you're not getting management letter findings, you're not getting regulatory findings and uniform guidance reports and so on. So pay attention, ask questions, and if there's ever anything that we miss during these presentations, obviously reach out to us and we're happy to guide you through it at a separate point in time. So we start with revenue and contributions. So I torture my staff by telling them that revenue and contributions are not the same thing. They're used interchangeably. They kind of are still used interchangeably in the accounting standards, but I don't think they should be. I like to distinguish between what's an exchange transaction revenue and what's not. So the determining factor there is it reciprocal or is it non-reciprocal? Reciprocal meaning both sides get something out of the relationship, out of the arrangement, out of the transaction, the contract, whatever it is. Non-reciprocal is obviously one direction. That's what a contribution is. It's somebody giving and not really getting anything in return other than the positive altruistic feeling they get from being generous, right? So that's something that you have to make sure first. If you're getting any sort of donation, government contract, revenue, whatever, you want to make sure you're understanding it at the top level. Is it a reciprocal transaction or is it non-reciprocal? So reciprocal, like I said, bidirectional, non-reciprocal, one direction. So when you get to step two, let's say we determine something is non-reciprocal, it's a contribution. Now we get to another decision tree. Is it conditional or is it unconditional? And we'll walk through these different things. And then from there, if it's conditional or unconditional, is it restricted or is it not restricted? So it's a little bit ridiculous. It's definitely hard to interpret and understand, but it is definitely something that is workable. It is something that you can figure out. It is something that you can be on top of to make sure that you're properly accounting for things. So we'll go into that step one. An exchange transaction revenue is covered under this accounting standards codification number 606, revenue from contracts with customers. So the intent here is to acquire goods and services for direct use by the resource provider. So we'll give some examples because those tend to resonate more than just these words on the page. So if a government entity hires a nonprofit to run, let's say, a compliance training for its own government employees, government agency is getting something out of that. It's getting trained employees, and the service provider, the nonprofit, is getting money, right? Someone's getting something on both sides of the coin. These are typical for fee-for-service arrangements, contracted services, things like that. Contributions tend to be the other way around. The intent is really just to support the nonprofit's mission. And whoever's supporting that mission is not getting anything in return, nothing tangible, at least, in return. So let's say a city agency gives a grant to a nonprofit to run a local homeless shelter. Government isn't receiving commensurate value, right? The general public is. So therefore, it's a contribution. There used to be an argument made before the rules were clarified that, well, it's the government's responsibility to provide these services, right? So if they're giving a grant to a nonprofit to take the place of themselves as the government agency to do this work, well, then it should be an exchange transaction, because if it wasn't for that contribution or that grant, the government agency would have to do it itself, right? That doesn't fly. The accounting standards specifically refute that now because they've gotten wise to what was going on in real practice out there. So what happens here is, in practice, we're seeing more and more government grants be considered contributions from an accounting standpoint. It's worth noting the word grant isn't defined anywhere in the accounting standards. It's something that we create, something that program people, nonprofit people talk about and use all the time. But really, that's not what this is all about. I'll flip ahead here. Once we determine that something is a contribution based on that first step, how do we determine if it's conditional or not? It's worth noting here, and it's important, because if it's conditional, it can't be recognized as income, as a contribution, until the conditions are substantially met. So a condition has to have these two different elements in place to apply. If it's not conditional. Sounds like word salad, and it is, but I'm going to try to do the best to explain this. So conditions come about from measurable barriers on a grant or a donation or a contract. Measurable barriers can be specific outcomes that are required. For example, placing people in permanent housing. It can be a matching requirement. So, if someone give you $10,000, if you raise 10,000 new dollars, that's a condition. The most common one is this third bullet, the incurring of qualifying expenses. And this is cost-based reimbursement contracts that we see very frequently with government agencies. So if you have a reimbursable grant, if you have a deficit-funded grant, whatever term you want to use to call it, those are in actuality conditional contributions, more likely than not. It's worth noting here that minor administrative reporting is not a barrier. Most grants have certain reporting requirements to them. It could be an annual report, it could be semi-annual, it could even be quarterly. But if it's not imposing conditions in and of itself, it's just asking for a report of what happened without any teeth behind it, that doesn't really count as a barrier. So assuming a grant or a contract has that barrier, or a barrier or any of these barriers, you also have to look for a right of return or a release in order for something to become a conditional contribution. So that right of return or release is a legal mechanism whereby you can claw back funds. The donor can take the funds back. The barrier is not overcome. The donor has to be explicit right to demand its money back or cancel a pledge. So if either of these are missing, it's not a conditional contribution. If both of these are in place, it is a conditional contribution. And again, the important distinction here is conditional contributions are not recognized until the conditions are met. Unconditional contributions are recognized because there are no conditions, really when the pledge is made to the organization. So there's a timing difference. And this is, again, what we see as our number one audit issue and our biggest source of management letter comments and findings is organizations not properly recognizing conditions on their contributions. So they're either recording all the revenue up front without having met the conditions, or they're not recording anything when they have met some conditions. That's definitely what we're seeing more and more of. And we really want to get the word out so everyone is aware of this and can properly assess it. It's not always easy, right? Finding these barriers and these rights of returns, it's not always standing right out in the contract terms that you're getting. Donors don't know about this stuff, so they're not writing their award letters to you, factoring this in. So it does require interpretation. And I would tell you, if you're a client of ours, reach out to us. We'd be happy to interpret any of these for you. If you're not a client of ours, one, you should be, but two, even if you're not, we're happy to help anyway. Reach out to us and we'll walk you through it and figure out how these things should be accounted for. So now we're past the condition argument. We're getting into restrictions. Restriction and condition sounds like the same word. I wish they were something different here, but they're not. And this is, again, muddying the waters a bit and adding to the reasons why organizations don't always account for these correctly. The key distinction at the bottom, restrictions affect net asset classification, not the timing of the revenue recognition. Okay, so donors, if they don't have those conditions, if they don't have barriers and a right of return, then the revenue is recognized, or the contribution, is recognized entirely up front when the pledge is made and really enforceable and something that you can bank on receiving. Restrictions can be in two different forms, really. And net assets are presented in your financial statements as with or without donor restrictions. Time restrictions are when funds are explicitly designated for future use in a different period. Multi-year pledges are inherently time restricted. So if we have a 5-year pledge, $100,000 a year, you're picking up $500,000 of revenue upfront, but the parts that are not to be collected yet are considered time restrictions for use in future years. It's worth noting that releases of these restrictions for time take place when they become due, not necessarily when they're collected. Collectability is a whole separate issue that we'll talk about in a couple of slides from now. Purpose restrictions are typically for programmatic reasons or something else. Basically, a donor may tell you that you have these funds now, but they have to be used for a specific reason, a program, project, capital campaign, assets, things like that. And releases from restriction to without donor restrictions occur when the qualifying expenses are incurred. So we have a problem here too, right? Again, more confusion. Most conditional contributions are dependent on spending properly, and most purpose restrictions are dependent on spending properly. So now we're in this gray area of what's a condition versus a restriction. So I would flip back to the prior page to make sure, again, reiterate, for something to be a condition, you have to have these barriers or a barrier, and you have to have a right of return. If you don't have a right of return, chances are that's a donor restriction and not a condition. So to sum it all up here, and again, this is the most common area of confusion for finance teams that we're seeing. Condition is the if and the when. Dictates whether you're entitled to the money and when you recognize the revenue. And money unless we do X, Y, or Z. The accounting for it is deferred revenue or refundable advance, some sort of liability until the barrier is overcome. So if you get a $100,000 conditional contribution today, you haven't met the contributions and the money is in the bank, that's a liability. If you never meet those contribution conditions, you have to give that money back. The liability comes off the books. It never hits your income statement, your revenue or expense. When you start expending and you fulfilling the contribution conditions, then you pick that liability up into income. Restrictions, the how and the where. Dictates how the money must be spent. Tends to be at a less strict level than the conditions and where it sits in the balance sheet. So the money is yours then, but you're legally bound to spend it on something, some program, some purpose, some future period. The accounting for that is contributions revenue or contributions when you're getting that pledge, and it'll be coded as with donor restrictions in your statement of financial position. So we started with this because it is, like I said, again, the area that we are finding the most issues. Some real world examples here. Let's say a foundation promises $500,000, but only if the nonprofit successfully obtains building permits by December 31st. The permits are denied, the grant is canceled, the money goes back. So there's no revenue recorded here. There's no contribution recorded because a condition hasn't been met yet. Once a condition is met, it becomes income. The other side of the coin, restricted, a foundation gets $500,000 or gives $500,000 up front, states it must be used exclusively to build the new clinic. Nothing about a right of return. Doesn't say exactly how you have to build the clinic. Doesn't say exactly how to spend the money. It's just here's $500,000. Use it to help build that clinic. So that immediately becomes recorded as a contribution with donor restrictions. And as you spend it and fulfill the restrictions or the obligations under the award, you would release those dollars from with donor restrictions to without. The revenue's already been picked up immediately, though. And there's also a simultaneous release rule. If a grant is both conditional and restricted, because that is possible, revenue is recorded or contribution is recorded as without donor restrictions at the exact moment the qualified expenses are incurred. Poll just popped up. Please answer that. That helps everybody get the CPE credits that they deserve. So there's also some disclosures and audit prep, say pointers for this area, contributions and revenue. If you do have conditional promises to give that haven't been met yet, the conditions haven't been met, you want to disclose and should and have to disclose the terms of those. This is only if they're material and how much has not been met yet. And you might want to put in there that we expect to fulfill these conditions in the next 12 months or something like that. This way the reader of the financial statements can see that and knows that there is additional revenue coming into the organization once these conditions are met. You also have to include liquidity notes showing how restrictions can impact cash availability within 1 year. That's a required footnote now. Came about a few years ago. The key point here is that if you have restricted dollars, you can't say they're available for general use, right? So you have to update the liquidity note to carve those dollars out if they're restricted for something else. And what we're recommending is really organizations, one, be cognizant of this, right? Realize that these rules are in place. Two, then, when you're getting any sort of contract, award, contribution, whatever, make sure you're looking at it through this lens of conditional versus unconditional, restricted versus not restricted. Make a master contract matrix or something like that that tracks these barriers, tracks these restrictions. Document your judgment when there's a probability of meeting barriers. You record the income when the barriers are substantially met. So there may be some judgment involved with that, and document that. So when your auditors come in or anyone else, you can show them, here, we met it. This is how. You want to be concerned with auditors from people like us, but also from the funding agency. Could be a government agency and they have auditors and they come in and they look at the stuff too. Ensure routine administrative reporting is not mistakenly classified as condition. We hear that sometimes, that argument back to us where, well, it's conditional because it says we have to send them a status report at the end of the contract showing what we did. It's specifically called out in the standards that is a minor administrative requirement. It is not a condition. So don't confuse that. Okay, we'll put contributions behind us now. We'll move to CECL. Accountants like acronyms, nonprofits like acronyms too, so sorry about that. This stands for Current Expected Credit Losses. It's a new way of accounting for bad debt reserves, allowances for doubtful accounts, credit losses, whatever you want to call it. It's all the same thing. So the old model that has been used forever is this FAS 5 model, right? When you're aware of an incurred loss, you record it. So you only record an allowance or write off something from a receivable when it is probable that a specific invoice or receivable will not be collected. Once you become aware of something, a funder going bankrupt, for instance, is an extreme and obvious example. If they owe you $100,000 and they're out of business and have no money, that's become a bad debt. You would account for that then under the old model when you become aware of that financial difficulty. The new model doesn't like that. It's more conservative. And this comes from banking. So everything that happens at a much larger level, when the banks are overvaluing their loan portfolios, that unfortunately eventually trickles down to nonprofits who really don't seem to be affected by this, but they become affected by it. So the new model is on a day one, you have to record a loss for projected future bad debts. So you record an allowance for the lifetime of expected losses as soon as the receivable is generated. This is for trade receivables, tuition, fee-for-service, revenue type receivables. This is not for contributions. Pledges and contributions are specifically scoped out of this. They're not covered by this credit loss model, but really you can approach it the same way and get to the same point if you did that. And we wrote here at the bottom that segmenting is important. Receivables should be pooled by risk. If you have higher risk receivables versus lower risk, they should have different models applied to them to determine what the bad debt reserves should be. We'll get into that. There's a short-term expedient here, right? Instead of going through, and really the model requires you look at historical analysis, bad debt write-offs based on your industry and risk profile, and all these other things that a small nonprofit really isn't well equipped to handle. So how do you get around this? Well, there's no way around it, but a nice shortcut is to look at subsequent cash receipts. This is something that auditors have been doing forever. Basically, the example is if you have $100,000 of receivables at the end of the year, and by the time, let's say, the audit is being performed and you're closing the books in the middle of March, which, it's an aggressive closing timeline, but it could be even later. If you've collected 85,000 of that, well, then it's not bad, right? It's come in the door already. There's only $15,000 that are uncollectible, potentially uncollectible in total, and you would model based on that. So this drastically reduces the arbitrary audit modeling, makes it less, hypothetical and more realistic. So say whatever the latest date you can close the books for this purposes, you should perform a subsequent cash receipt analysis to see how much has come in and use that to inform whatever bad debt modeling decisions are. But something that we're seeing more and more, not more and more, really consistent with the past, but we get the answer all the time, all our receivables are collectible. We work with government agencies. We'll always get everything, which is a leap of faith. It's a great assumption, but it's probably not always true. So you kind of have to prove that out. If you can prove to yourselves and then your auditors and anyone else that bad debts have historically been minimal, immaterial, then maybe you don't need to do anything beyond document that and show it. But it is definitely something that should be considered. It's something that should be thought about. It's something that should be prepared for. Don't be surprised by. Your auditor should be asking you about this new standard. It should be in all your new financial statements as note disclosures in the back. There should be more words there explaining how you're coming up with your bad debts, and really you should be factoring all this stuff in. Leases. So leases, not new, the new-ish lease accounting standards, we'll call them. ASC 842 was really putting on the books an asset and a liability for the value of future payments that you make pursuant to leases. And what happened here practically was that you're now seeing more and more operating leases for physical space become assets and liabilities. And if you have a long-term lease, 3, 5, 10 years, the number becomes pretty big and it sits on your books forever as this gigantic number that, not forever, it slowly amortizes down over time. Becomes a confusing thing, becomes a confusing spreadsheet to keep track of. It's also a source of significant errors and adjustments that we have during the course of the audit. So before we even read what's on this page, I would advise everybody to go through, make sure you're looking at your lease contracts, make sure you're understanding how the accounting for that should work. Look at the, discounted cash flow models that build up to the asset and the liability balance and understand it. And you really should be able to account for that yourself. If you can't, the auditors are going to probably ding you with a comment after the year because it is technically a management receipt to do this kind of thing. So that's what we have in here, because day one we've been talking about for probably 4 or 5 years. I'm sick of talking about it, honestly, but it is still out there. So day two accounting, what's important for leases and how they can be modified. Well, lease modifications, extensions, early terminations, that all can update and influence the evaluation of the asset and the liability that's on the books. So if you have that type of thing happening, you want to make sure that that's being taken care of and accounted for. renewal options that was previously deemed reasonably certain or maybe wasn't certain. Same thing. That can push out the calculation. That can make you have to add in more layers of years that would build up the asset and liability further. So that's something to keep in mind too. And impairment. Abandoning a leased property requires impairment assessment of the asset, even if rent payments continue. So you might have a liability in the books, but you might wipe out the whole asset if you've just given up on the space. So you give up on a space and you're just paying out the lease as you've moved on. You'd still want to impair those assets and take them off the books because they have no future value to you. So, leases is day one is complicated enough. Day two, just be aware of what's going on with those lease contracts and make sure that you're properly accounting for whatever happens there in terms of changes. It's also embedded leases. This is the danger. So we tell all of our clients if something's tiny and immaterial, it really doesn't matter, right? You want to account for it in compliance with the standards, but we won't care if you don't, if it's a, $300 a month copier machine on a $10 million organization. That's never going to be a significant thing that matters to anybody. But there are embedded leases that you may not be aware of. Things that don't specifically call themselves leases in the contract, you have to be aware of. Maybe they are leases from an accounting standpoint, right? So the key phrase here is conveying the right to control. It's a right of use asset. Right to use it has a value to you, so it's an asset. That could be embedded in IT contracts. If you have dedicated servers or technology equipment that you're using that is only yours and only your use, that may have a value that you have to worry about under the lease standards. Transportation, vehicles, right? A lot of organizations have transportation. They have buses or vans or even cars for executives, things like that. Those technically are leases subject to the lease accounting rule that you put the asset and liability on the books. You may have dedicated medical equipment if you're a healthcare organization. So all these things again, we're putting concepts out there so you can be aware of what's potentially a problem area when it comes to leases. The way that auditors will find this type of thing is to look at different expense accounts, right? If it's not set up on the books as an asset or liability, then you're probably just expensing the payments every month. So we will look in IT, we'll look in professional fees, may look in transportation costs, things like that, contracted services, to see if there's things that stand out and appear to obviously be some type of contract that gives you the control over some sort of asset. There's some new rules coming down, which probably won't affect most of you, but it might affect some of you. We have some clients that are engaged in developing software that's unique to them that they may use to serve their population, or they may use internally or something like that. We have other clients who actually develop software that's used in the outside world and may be licensed. There's all sorts of different ways that software is now appearing and becoming more prevalent, especially with AI and the cost of coding and developing is going down, it seems, or it's just become easier to do. This is something to be aware of. So there are new internal use software accounting regulations that are out there. They can be early adopted. If they're not, they're effective for calendar 2028 organizations. Really, what it boils down to is a modernization of the existing accounting rules that came about in like the 80s, right? I mean, software development hasn't been around that long in the grand scheme of things when you think of, other business transactions. But it's been decades, and it's been decades since it's been updated to reflect the new world. It's been antiquated for quite some time, quite honestly. So there's different ways to look at software development. They have always been looked at in different stages. And now there's 3 broad stages that have been set up. The preliminary project stage, during which time costs are expensed. So when you're evaluating vendors, scoping out requirements, things like that. The application development stage, when you're coding, configuring, testing, qualifying costs become capitalized there. And what are those costs? What qualifies? Tends to be outside contractors who are developers. They may be overseas. They may be here in the U.S. Could be staff, salaries, and then related costs, all subject to this. And those could potentially be capitalized. And then the post-implementation stage, when you launch the software for internal use or for external sale, training, routine maintenance, things like that become expensed. Moving to cloud-based ERP, CRM systems triggers complex capitalization rules. That's something to note too. You may enter into service contracts, but part of that and the setup and the development might actually be capitalizable, which is good. You'd rather have an asset on the books depreciating than to immediately expense something. So again, Introducing a concept here. If you're developing software, just know the rules are changing. There are rules, first of all. A lot of organizations don't realize that. They're just expensing everything. So there are rules to follow, and there are seemingly easier rules to follow if you decide to early adopt this and implement it before the effective 2028 year. So the challenge is the existing rules were written for sequential development. Modern software uses a continuous, we're calling it agile sprints, where scoping, coding, things happen simultaneously. In the past, it was more linear. So there are certain points at which you could start capitalizing. It was a technological feasibility level was met. That doesn't really apply anymore because things are just all over the place. And that's just the way it works now. So the solution is finance must really work with IT. This is the challenging part. The finance people, the accountants, are not the developers. So they don't really quite understand this. They're not trained in technology and software development. So they need help from the IT folks, the software coders, and whoever else to bridge the gap between what's happening in the software and how that meshes with the accounting literature to make sure that you're capitalizing and expensing things at the right point in time. And again, worth noting down here, even if a cloud contract itself is an operating expense, it's not a lease or anything like that, a monthly SaaS fee for use of whatever, QuickBooks Online, let's say, the implementation costs of that, if there's a significant upfront cost, can often be capitalized and amortized over the contract term. So again, if you're changing software, if you're changing systems, if you're going on the cloud, if you're developing software, just realize there may be accounting implications for that. And you can read about that on your own, or you can reach out to us or anyone else who can help answer questions about it. I'd like to introduce another acronym for you. This is totally changing gears. A lot of organizations on here may be funded by New York City in some way, shape, or form. So New York City, without getting political, it's definitely bureaucratic, right? Getting contracts signed, getting payments, dealing with audits. It's certainly burdensome for they themselves in the city and the organizations that work with them. So they're trying to introduce a new reporting framework that would standardize that, make it a bit easier for them, not for you. Maybe for you if you have a bunch of different audits happening and you can just deal with one instead of 10. But principally, this is meant to consolidate and simplify their auditing. So the SAFER, Standardized Auditing Financial Reporting Framework, has been introduced. It's not effective yet. It's not out yet. Doesn't apply to you tomorrow. They're trying to work out the kinks and figure out exactly how this is going to look and feel. They're working with CPA firms. We're one of the firms that are helping to kind of guide this and make sure it doesn't get too crazy, and that it actually is realistic and able to be implemented. It's for health and human service providers. So it would feel a lot like the uniform guidance rules, which are, if you receive over $1 million in federal funding, you have to get this compliance audit. This would be if you get $1 million of city funding from health and human service agencies, you'd be subject to the SAFER requirement. It would be leveraging single audit and New York State CFR work, which is separate. So it wouldn't be repeating that. It would pretty much mostly be New York City, HHS, purely funded agencies getting over $1 million or expending over $1 million in any reporting year would be subject to this. So for you, just know that it exists. It's early, but you want to start preparing yourself for this. And because it does seem to be an eventuality that it'll be in place maybe in 2027 or 2028. But it's really a data compliance and readiness exercise, not just an audit one. So they're going through beta testing. We'll share more about this. Stay connected to us online. We'll push as much content out about this as possible. And the key takeaway is you want to be able to produce clean contract level financial data, right? So if you have 10 different city contracts, you want to make sure you can track within your system the revenue and expense, who's allocated to there in terms of employees, how many hours, and what their titles are, and all this other stuff. And that whatever you're doing is defensible. So these are the agencies listed in the manual that this will be subject to for now. Again, all health and human services ones. The $1 million threshold is based on expenditures from one or more participating combined, not just one individual contract. And it covers those that also receive money passed through federal, state, and city sources. So that's important to note too. Similar to the federal requirements, that pass-through dollars are what matter as well. It's not just what comes directly from the source. For-profit entities are addressed separately, not the focus of this. So this is a nonprofit auditing compliance rule that will be in place soon that you'll be subject to if you have this type of funding. So the submission would happen annually along with the organization's financial statements at single audit at CFR. through the Passport Vault, PDFs being uploaded. There's course schedules here. Basically, if anyone's familiar with the CFR, it feels similar to that. Also similar to uniform guidance, basically asking for, like I said, contract level revenue, contract level expense, organization-wide balance sheet, information on individual employees, the board, key officers, things like that. And they'll be in a prescribed format that will have to be audited by your auditors. So expect a fee increase for this. And then there's other information reports showing program details, executive comp, maybe units of service, things like that are going to appear in here. So what's also always kind of been behind the scenes in your audit is now coming front and center and going to be more explicit and more granular to deal with. You would expect the same CPA firm that you're working with now to work on that. It's very important. For uniform guidance, it's almost required for the federal. So here it might become required, but that's sort of the expectation there. There would be a deadline they're talking about now. The earlier of, so the earliest of 30 days after receipt of your audit report or 9 months after year end. So again, it feels similar to what uniform guidance is for federal. Weekends, federal holidays, we don't really need to worry about that yet. So what should you do now? This is what's most important because it doesn't really apply yet. There's nothing to file yet, but you want to be able to map every contract to determine whether it's covered by single audit or CFR, or if it's New York City only, that may require SAFR, safer specific testing. By the pool of contracts that this applies to. It's not everything, but you might have 1 or 2, you might have 10. You want to be prepared for that and know which of these contracts are going to roll up to the safer in the future and be required to be reporting this way. You probably already maintain the contract level expenditure because chances are these programs are deficit funded, but you want to make sure you have that for sure. You want to make sure that's auditable. You want to make sure that you can produce, in a sense, contract level P&L statements. That's going to be on the prescribed safer forms. Want to ensure that all the salary allocations, indirect costs, and things like that are properly captured in a way that is allowable based on reality. You know, we tell a lot of organizations you need to do time studies if you're carving up someone's time between 5 different contracts. The contractors want to make sure that they're not paying for what they're not really getting, right? So you have to make sure that time studies, time analysis, occupancy studies, square footage analyses, all these things are in place because that's what's going to support the allocations you're doing to these different contract level amounts. Because, you know, as soon as the city has these reports, they're going to send letters, they're going to examine, they're going to make sure that the numbers are what they should be. As always, make sure everything ties back to the audited financial statements, the underlying accounting records. Keep support ready for the allocability, reasonableness, generated income where relevant, and compliance with the contract terms and the HHS cost manual, which you should be familiar with or they're going to release. And there will be a whole manual, just like with the CFR. There's a gigantic manual that explains all this. You would think the city is going to do that. I'm sure they won't factor in everything. They're going to miss certain things. It's going to be questions back and forth, especially in the first year of implementation. But again, the takeaway, know this is out there. Start getting ready. Make sure that when this does drop, you're in a good position to be in line and not have to worry about it. I don't want to get into too many of the weeds here, but it's a type A, type B format, just like with uniform guidance. So it's not like every contract would have to be tested again, assuming that 10 example. If you have 10, you know, the auditor may have to look at the top 3 or something like that, but the principles have to apply to all of them. There may be a low risk, or there will be a low risk qualification where an auditor may have to test a little bit less than if you were high risk. All these things really have to be considered. So we're recommending everyone build a readiness calendar, assign schedule owners, test whether your GL can produce the required contract by contract outputs before your current year-end close. I want to quickly get to some 2024. So again, not brand new uniform guidance revisions. The single audit threshold, this is the most important one, was $750,000. It is now up to $1 million. So it's $1 million in federal expenditures will subject you to this uniform guidance audit. If you're at 900,000, you won't need that anymore. Some other changes here that are meant to sort of reduce administrative burdens for organizations and for the federal government too. Enhanced audit focus on cybersecurity costs. So the guidance is now allowing data protection and cybersecurity internal controls as allowable costs. So expect auditors to look a little bit more into that. Question cost reporting has gone up a bit, so maybe some relief there. Not a whole lot though, but again, the key takeaway is the $1 million instead of the 750. So to sum it all up, really to boil it all down, talked a lot about revenue and contributions. It's a pain point for us as auditors. It's a pain point for you. Be aware of the new rules, new-ish rules. Make sure you take them seriously. Look at contracts, look at awards, go back to donors. If things are murky or unclear, when you're getting these, have the donors clarify right then and there, or the government agencies, what they think this should be. And that can help. The SAFER and the federal compliance, review your city contracts, make sure that you're aware. If you seem to be in the line of sight here, if you're going to be subject to this, if you have $1 million in health and human service city contracts that aren't covered by uniform guidance, or aren't covered by the CFR, make sure you're starting to get things in a row here for the contract level reporting that's going to come. And for CECL and leases and software, CECL, just be aware of it. Look at your receivables, look at your bad debts, understand why your auditors are asking about that, because the rules did change and you can't just say everything's collectible anymore. It just doesn't fly. We get in trouble if we accept that. So you have to prove to us that that's the case and why. Leases, just keep your eyes out for any new type of embedded leases that are out there that you may not be aware of. And then software, if you're doing that, the rules are changing. You may want to early adopt. It's probably in your best interest to do that. The other thing, I didn't say it, but we lived through revenue recognition rule changes. We lived through lease accounting rule changes. The CECL thing for bad debts is nothing major from an accounting standards standpoint that should be affecting nonprofits in the next couple of years, which is good. We don't always get to say that. So we've kind of dealt with the big three now. City and federal government requirements aside, there shouldn't be anything new or exciting that's coming down the pike. Just really focus on what's going on now with these newish rules. Make sure you're really fully aware of them and that you have no issues going forward with them. Because if you do, then it should be smooth sailing. There's nothing over the horizon that's going to scare us into, worse times. All right. Thanks everybody for listening. If you did. And as always, we encourage you to reach out to us if there's anything we can help with, and enjoy the rest of your day and the rest of our update. Take care.